world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Andy Rachleff. Andy is the co-founder and CEO of Wealthfront, one of the world's leading investments and personal finance companies. Building around a core investments offering for young professionals, Wealthfront has added checking, savings, and debit functionality, plus automation, with the ultimate vision of delivering self-driving money, where personal finance is fully automated by software. Today, Wealthfront is announcing the launch of checking account features in a significant extension of its existing offering. Prior to founding Wealthfront, Andy co-founded Benchmark, one of the most respected venture capital firms on the planet. For all of our past episodes and to sign up to our newsletter, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Andy Rachleff. Andy Rachleff, welcome to Rebank.
Thank you for having me.
It's such a pleasure to connect. I've been looking forward to this conversation. You guys at Wealthfront are one of the absolute leaders in the digital investment space, one of the early players, and also one of the most successful. I think what we're going to be discussing today will be not only an interesting new product launch, but hopefully a bit of the context for what that means about the future of Wealthfront. So maybe just to kick off, could you quickly introduce yourself and tell us a bit about Wealthfront?
Sure. My name is Andy Rachleff. I was a career venture capitalist before I became an accidental entrepreneur. I was 25 years in the venture business, the last 10 of which was a firm I co-founded called Benchmark Capital. I retired to give back, and one of the things that I was doing was teaching at Stanford Graduate School of Business. When this idea came to me as part of something else I do, which is serve as a trustee at University of Pennsylvania and chair their endowment investment board. And so today, Wealthfront's a next-gen banking service that helps young professionals optimize their savings. We provide no account fee banking and low-cost investment management, all through the highest-rated financial app in the Apple App Store.
Wow. Well, amazing backstory, amazing pedigree, and I would highly encourage everyone who doesn't know the story in detail already to go check out some of the other great conversations or content on Wealthfront because it's fascinating. But today I wanted to look forward. I understand that you guys are have launched potentially by the time we push this, an interesting new product, which I'd love for you to tell us about.
Sure. Well, a little over a year ago, we launched a high-yield cash account. And the response to it was beyond our wildest dreams in terms of the amount of assets that we were able to collect. And so we thought that it would make sense in order to combine the best features of a savings account, which is what we had, with the best features of a checking account. So last week, we just introduced a bunch of checking features to add to our high-yield cash account. So specifically, you can now direct deposit your paycheck and get paid early, believe it or not, up to 2 days earlier than you would normally in your regular bank. You can pay bills and your friends from the account, and you can make purchases and take out cash versus our combo debit and ATM card. So basically, we're offering a hybrid of a checking and a savings account that earns you interest on all your cash, and we get you your paycheck 2 days early.
All right, so I can understand why that fits naturally within the product suite that you guys offer. Real quick, maybe just pick up on that high yield savings account. So I think I remember when you launched that, it must have been last year, and I think I remember reading some headlines about how maybe in the first month or so you raised something like $1 billion in deposits, which is a phenomenal figure. And I imagine that it's continued to grow since then. Can you talk about that cash product and why that was so interesting to your users at the time?
Well, it was really simple to understand. We offered a much higher interest rate than everybody else. We offered higher FDIC insurance. A traditional savings account offers $250,000 of insurance. We offered $1 million of insurance. And we offered unlimited withdrawals, whereas a traditional savings account only offers up to 6 withdrawals in any 1 month. So it was a better product than what you would find in a traditional bank. And now we're unique in that we've taken all of those great features and added checking features so you can get paid on all of your money. Unfortunately, people keep separate checking and savings accounts. There's no reason to do that other than you don't want to have a bunch of money laying around on which you don't earn any interest.
So now the launch of the checking account makes perfect sense. Can you talk a little bit about the demographic of your user base and how the design of the specific checking account was informed by that?
Sure. Well, we're focused on young professionals. We like to call them millennials who save. You know, the traditional narrative about millennials is they're all out of work, smoking weed, living in their parents' basements. And that's just not true. Like every other market, there's an 80-20. 20% of the 90 million millennials out there are doing exceptionally well. And we're trying to build a complete suite of services to help those millennials who save manage their savings for the short and the long term. Deloitte has done some market research that has shown that in 10 years, millennials as a whole will have about $12 trillion of assets. And we think that the millennials who save will have over 80% of that. Traditional market, 20% of the people have 80% of the assets. And so if we can do a really good job serving them, where everything is automated, you don't need to talk to any bankers, you don't need to go into a branch, there aren't any fees that would cause you to be frustrated with your bank, then we think we're going to earn a disproportionate share of those assets.
Do you expect the checking account to attract net new customers to Wealthfront, or is this going to be an enhancement, a deepening of a relationship with your existing user base?
I drive my son crazy when I answer that question by saying yes. It's both. And by the way, it's not a checking account because technically we're not a bank. But what we can do is we can offer the best of checking features and savings features in what we call a cash account.
Gotcha. Is that different than what others in the market, you know, whether it's like a Robinhood or a Betterment or even a Chime in partnering with a sponsor bank has offered? Or have you guys followed that same structure?
No, because they're separate. They're offering separate checking and savings accounts, which means that you have the inconvenience of having to move money back and forth between those two accounts. So we get rid of that problem, that you can just put all your money in one account and you can spend from that account, knowing full well that you're earning money on all of that money. And then the other thing that will really leapfrog us past everyone else, beyond the advantages that we have today, is when we start rolling out what we call our self-driving money features. So this year, we will deliver the capability for you to direct deposit your paycheck with us. We'll automatically pay your bills, and then we'll route the remaining money to the most appropriate place, depending on your situation and goals. So if you're saving to buy a home, that money should be in something highly liquid that has no market risk. If you're looking to save for your kids' college, then that should go into a tax advantage college savings plan known as a 529 account. We would route that money there. If you're saving for retirement or just to grow your net worth, we would put that probably either in an IRA or a taxable investment account. But imagine when your life goes on autopilot and you don't have to think about any of these things. The money's just automatically routed to the most appropriate place.
All right, so this is this panacea of personal finance, which we've all been dreaming about for years, if not longer, and you guys you're delivering it. How long has this been a work in progress?
Well, we've been building toward it. A couple of years ago, I started talking about our vision of optimizing and automating all of your finances. One of our engineers coined the term self-driving money as a much pithier way of saying that. In order to deliver on that vision, we've had to make a multi-year investment in a banking and brokerage automation system. So we've had a bunch of engineers working for over 4 years on that. And then we've had a bunch of engineers working on an advice automation engine. We first introduced it about 3 years ago, and we're building on that. So our typical client, our average client, links over 3 of their financial accounts to us. So they might electronically link their existing bank account, their brokerage account. If they own a home, their mortgage, we get all of their credit card receipts. And by taking in all of this data with their permission, and by the way, never selling that to anyone else, we're able to learn about the habits of our clients in a way that no financial services provider can. And we can take that information and customize a program that's ideal for you.
All right, so this is great. This is not, hey, you used to use us for investments. Now we also offer something that you would recognize as a checking account, and you should do that too. This is almost an extension in a way, like new functionality is deeply integrated with the core foundation of what Wealthfront offers to extend the value to your existing customer base and any new signups. Is that a fair characterization?
That's an absolutely fair characterization that has been years in the making. We're a technology company. We're a technology company that does finance, not a finance company that does technology. Over half of our employees are engineers. We succeed by delighting our clients through product. Other fintech companies attempt to succeed through marketing expertise. In our case, we market through word of mouth. If we can really delight our customers, that we believe that's the greatest form of virality.
Can you just describe for me what, in your mind, the mission of Wealthfront is, and to what extent, if any, that's evolved over time?
Well, we've actually just broadened it. When we
Timely
started,
question.
It was a very timely question. I'm glad you asked that. So when we started, our mission was to democratize access to sophisticated financial advice. And we started that about 8.5 years ago. Well, in the last 8.5 years, we've revolutionized the investment world. We've made it possible for just about anyone to access as sophisticated an investment methodology as the premier university endowments employ. And we do this for minimums of $500 and a fee of only 0.25% per year. The world reacted by copying us, which is the greatest form of flattery. So just about every investment firm has a less featured and less capable version of what we first introduced 8.5 years ago. And supposedly by next year, there's going to be $1 trillion of assets in automated investment platforms. So we feel like we've made really great progress against our original mission. And as we've broadened our products to include other financial services like traditional banking products, that we need to broaden our mission. And so we've recently decided to broaden that mission to build a financial system that favors people, not institutions.
I like it.
And so what we mean by that is we want to deliver a very broad suite of financial services that are in the best interest of the client, not in the best interest of companies like ours. As Amazon has proven, if you build great products for people, you can do just fine sharing much of the economics with your customer. And I love the double entendre of the mission statement because we're building our own financial system that favors people, not institutions. And if we succeed at what we're doing, we think just like in the investment world, we're going to be emulated, and maybe we can actually impact the entire financial system.
All right. So if I play devil's advocate for a minute, just to have a little bit of fun, there are people out there who say, okay, the robo concept, and I appreciate that we've moved on from there, but basically the idea of offering professional quality investment management services on a democratized basis at an extremely low cost, which those who have any background or training in investments generally believe delivers the best long-term results, makes a lot of sense. It didn't have the disruptive effect on the retail investments industry perhaps that people expected, and actually people are signing up in droves for Robinhood. What do you say to that? I mean, is the holistic, democratized financial management the right approach, or do people just want something that's fun and sexy?
Well, it all depends on how you define these things. If you define it by assets, we have a huge multiple of the assets that Robinhood does. They have more clients who are gambling in a casino. So on a dollar basis, which is the way that the investment industry measures things, we've had an enormous impact. If we've created an entirely new segment with $1 trillion of assets, that's unbelievable. And as a matter of fact, disruptions of the sort that Clay Christensen defined, and he's the person who coined the term, the Harvard Business School professor who sadly passed away last year, he says that disruptions actually take longer than true disruptions take longer than other kinds of initiatives. And what you find is that we have been adopted at a faster rate than ETFs, and ETFs were adopted at a faster rate than index funds, which were adopted at a faster rate than mutual funds. So if you actually go back and plot these things, we've been adopted at a really fast rate. Robinhood just took something that was existing and made it free. They did a great service for do-it-yourselfers. We served delegators.
I guess different question, but similar vein in that it's, again, related to competition. We've seen amazing consolidation, in the past 12 months or less in the kind of discount brokerage space. First, it was a move from the sort of traditional AUM-based charging structures to a subscription model, which even as recently as maybe a couple years ago would have seemed unlikely or impossible for the industry to adopt. Now we've seen large-scale consolidation and free or extremely low-cost offerings from a lot of incumbents. How does Wealthfront position itself going forward vis-a-vis the Schwabs of the world who are now offering extremely cheap services to customers?
Well, their robo-advisor is free, and they've attracted $40 billion of assets, but only $4 billion from new clients. Just because it's free doesn't make it good. Not all software is created equal. We're really good at building products. We've attracted a huge multiple of that amount of assets into our investment service. And we did that by building better products, delightful products. Financial services companies are not very good at software, so they buy other companies in order to reduce their costs to make more money. We build new products to make more money. We think our real competition are the big four banks, people like Chase and B of A and Wells Fargo and Citibank, because that's where most of the money is today. And they're not very good at building products. As a matter of fact, Chase tried to build a personal finance tool called Fin that was an unmitigated disaster that they ultimately had to write off. They all know they're not very good at it. And what's recently happened with the pandemic has only exacerbated this problem. I tried to close an account at Wells Fargo a couple of weeks ago. And when I called, which was, by the way, the only way that I could do it, I was told that there was a 3-hour wait time. In our case, our customer service reps, who we call product specialists, each handle on the order of 35,000 clients. The only way that they can do that is if they're almost never used. And so our load didn't go up at all during the pandemic. It's because of our great products.
All right. So back to this self-driving money point, because, it's just obviously where the industry seems like it's going. And the fact that you guys are launching this now feels like you're significantly ahead of a number of your peers in the space. Do you have that feeling?
Yeah, because in order to deliver self-driving money, you had to have made a very large investment in automating the brokerage and banking infrastructure, number one. And number two, you had to invest in advice automation. Well, there's only one other company we know of that has invested in automating the banking and brokerage infrastructure, basically building something from scratch, and that's Robinhood. So we and Robinhood are the only two that have done that. But we're the only company that has automated advice. And the whole idea of linking up all of your accounts and ingesting that data and drawing inferences upon that data to be able to deliver that advice, no one has done that. And you can't just replicate that overnight. So this has been in development for a long, long time.
I mean, I love the concept, love the offering. It's it's a genuine service to the vast majority of Americans, and I look forward to watching you guys scale it.
Well, actually, it could be to the vast majority of Americans, but it's probably of greatest interest to people who actually have saved some money. Because routing your money into the most appropriate place isn't of much value if you're living paycheck to paycheck. So you mentioned Chime before. We think Chime does a really good job for people who are unbanked or living paycheck to paycheck because they don't have a single account that pays you high interest and gives you the checking features. But if you want something simple to get going with, they're just fine. But if you want to be able to take maximum advantage of the money you've saved, then we're second to none.
So because of the demographic that you guys serve and the vast number of customers that you have, I'm sure you have interesting insight into the way that people have been responding since the COVID crisis arose in the US kind of March time, and the way that millennials are thinking about money and finances looking forward. Is there anything you could share along those lines?
Yeah, they're actually doing a hell of a lot better than you would think. So our clients, the unemployment rate among our clients is only on the order of 3%, which is much lower than the national average. And their savings rate, which was 15%, has gone up over 2x.
What do you make of some of the, I don't know, they feel to me a bit dated now, and perhaps they're a bit simplistic to begin with, but all these articles and thought pieces about how actually the millennial generation was completely different than any other generation that's ever come before it. They don't want to own homes. They don't want to own anything. They don't want to work continuously in the same profession or for the same company for a long period of time. Is that true based on your guys' experience, or would you challenge some of that?
Look, these are gross generalizations, but I can tell you that there's definitely a greater preference for experiences than assets than older generations. They don't need to own a home. They might prefer to use that money to travel around the world. Unfortunately, we can't do that right now. But in order to address that on our automated advice, we actually tell you how much time you could afford to take off and still be able to meet all your financial goals. So that's an example of a feature that's designed specifically for our target audience.
It sounds like you're squarely focused on the millennial audience, the millennial customer. Have you spent much time looking at or thinking about younger generations, Gen Z, and how they may be engaging with fintech or investments or financial services?
Not really, because they don't have any money yet. And our business model is focused on making money on that money. So we earn a small spread on the cash that you keep deposited with us despite paying a really high interest rate. We make an advisory fee on the investment accounts that's a tiny fraction of what other people charge. So we take advantage of our automation to lower our cost and share the economics with our clients. But our business model is based on assets, not number of people or advertising. So very young people really aren't appropriate, number one. Number two, when you're very young, you haven't yet learned the lesson that the academic research has clearly proven time and time again, which is it's almost impossible to outperform the market by investing yourselves. So Robinhood is really popular with very young people because they have yet to learn that it's a really dumb idea to trade stocks. So we let them go off and use less featured banking services and trading services so that they can come to their senses and realize that we can do a much better job for them.
So because of the COVID crisis and the expected, I guess it's maybe more than expected. I think it's actually declared a recession by now. We've seen different startups, I suppose, for lack of a better word, not that Wealthfront is much of a startup anymore, but different companies take different approaches to fundraising, to layoffs, to cost management. How has the economic environment impacted the way that you're running Wealthfront and any fundraising that you're planning?
I think the biggest change is that it's focused us more on cash flow than growth. So we're willing to grow more slowly in order to use less cash. So we made a number of changes back in early March without any layoffs to significantly lower our cost base.
And with your former venture capitalist hat on, as you look around the market, are there other players, noteworthy players that are doing the right things, doing the wrong things? What impact do you expect this economic climate to have on the broader fintech space over the next few years?
You know, I'm so busy running Wealthfront that I really don't have much time to look around. I sat in on the Benchmark annual meeting a couple of days ago, and they were telling stories about how their portfolio companies have taken swift action in order to do the same, to reorient toward cash flow and away, perhaps in the short term, from growth. So I think the good companies are all oriented that way. I think that a younger entrepreneur might find that harder to do because they get addicted to the growth. And the faster you grow, the more money you burn. And historically, the companies that earn the highest valuations are the ones that grow the fastest. So that's a hard habit to break for some younger, less experienced entrepreneurs. But generally speaking, I think the good companies have all made that change.
You talked about the big four U.S. banks as your main competition as you see it.
That's where the money is.
Yeah.
You know, millennials haven't invested their money by and large. It's just sitting idly in the big four banks, primarily not earning any money.
Do you expect banks to use the recession as an opportunity to accelerate digital within their businesses and potentially close more bank branches in an effort to shore up their strategic positions? Or do you view incumbent banks as in any way being kind of structurally challenged going forward?
You know, to a bank, a branch is a strength. It's a true asset. And they try to leverage that asset. You can't just suddenly close down your branches when the vast majority of your customers, and more importantly, the vast majority of your assets are tied to people who like the branches. Now, it just so happens that millennials prefer everything to be done electronically via their phone. Our clients tell us, we pay you not to talk to us. So branches are not of much value to, we believe, not of much value to millennial customers. As a matter of fact, it costs a bank something on the order of $200 per client to maintain. So how do they get that $200? Well, it's by giving you less interest on your balance and by charging you more fees. When the Fed first started cutting rates this summer, Jamie Dimon, the CEO of JP Morgan Chase, was interviewed by Bloomberg and asked, what are you going to do if the Fed continues to cut rates? And without missing a beat, he said, raise fees. It's not going to be through cutting branches. That's what they did during the Great Recession. As a matter of fact, banks used to pay higher interest rates on their checking accounts, and they lowered them to zero during the financial crisis. And what they realized was it didn't affect their funds flow. So when interest rates went up, they kept it all for themselves. And they still paid zero interest rate to their checking customers. So banks face what's known as an innovator's dilemma, another term coined by Clay Christensen, that if they ignore disruptors like us, it's actually more economic to them. They don't lose as much money. But if they go after us, they're going to lose a ton of money. And if they ignore us, we're going to chip away at their growth opportunity, the young people. So they're damned if they do and they're damned if they don't. That's the innovator's dilemma.
Well, it sounds like they're in an even worse spot now with you guys launching this new product and delivering this self-driving money vision. This, I think, is very, very powerful, and I look forward to watching it evolve.
Well, thank you, Will. I really appreciate you hosting me.
Andy Rachleff, thank you very much for joining us today.
My pleasure.
Thanks for tuning into Rebank. If you liked today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.